Alex, welcome. Great to have you here in New York. Pleasure to meet you, welcome you to the Virtus family, which we've done here in the last month. Begin by just telling us a little bit about AlphaSimplex, the history of the company, where the company is today, and the vision for the company as we move forward.
Sure, absolutely. So AlphaSimplex has been around since 1999. In the early days, our focus was really on consulting and collaborating with institutions in the areas of risk management, trade execution, and portfolio construction. And then over time, starting in 2003, we started actively trading portfolios of futures contracts. And since that time, trading futures contracts across markets globally has really been at the core of our identity and our research focus at AlphaSimplex. Moving forward from 2003, or in 2008, we started taking our strategies and offering them in a liquid mutual fund format. We did that first with our global alternatives strategy, which is trying to capture the exposures of the hedge fund industry, but in a liquid format. And then later in 2010, we launched our managed futures strategy in a mutual fund vehicle. Fast forward to today, we're managing about $7.5 billion in assets under management. And those assets are a combination of assets that we manage for institutional buyers, as well as mutual fund assets. And across the board, for example, in our managed futures strategy, we are deploying the same strategy, the same approach, whether it's in the mutual fund format or whether it's in institutional accounts that we're running for institutions. It's really the best ideas across the board. And we're delighted to be partnering with Virtus and distributing these products to an even wider audience going forward.
And it's exciting to have you here. Now, I mentioned you're up in Massachusetts. Right. Tell us a little bit about the team, the expertise, and the background of some of the critical figures.
Sure. So our approach at AlphaSimplex is a quantitative and systematic approach. So all of the trading decisions, all the portfolio construction, everything that we do as a firm is really informed by our quantitative models. That means if you're looking at the research and portfolio management team, it's stacked with individuals with very strong quantitative backgrounds, but from a diverse set of different disciplines. So for example, we have folks who have backgrounds in operations research and bioinformatics, and personally, my background is in pure mathematics, and I have a PhD in computer science. And for us, what's important is that we have people with very strong quantitative backgrounds who can implement those systematic strategies, but from a diverse set of backgrounds, because for us, that's a source of diversification in our investment process.
So focusing on the what, not so much the why.
Yes.
Okay. Managed futures themselves, for a lot of the viewers, they might not be as familiar as you and I might be, but just kind of walk us through an explanation of managed futures, how they work.
The main strategy in the managed futures space is one of trend following, or following price momentum. And the idea there is that managed futures managers will be monitoring dozens of markets around the world, looking for signs that those markets are trending either upward or downward. And then the trend following approach is simply to, when you see a market looks like it's trending upward, to take a long position in that market, effectively betting that that trend will continue. And similarly, when you see a negative trend in a market, to take a short position in that market, to bet against it in the near term. And it turns out that a very efficient and effective way to gain exposure to those markets, either long or short, is through trading futures contracts. So for example, in our portfolio, we're monitoring trends in 95 markets around the world. These are markets that represent equity markets, fixed income markets, currencies, commodities, as well as short-term interest rates. And based on our analysis of the trends in those markets, you'll see us holding a long position or a short position in each of those markets at any given point.
Yeah, it's an excellent point, because I think when you talk about particular assets and you think of managed futures, immediately I think there's this inherent belief that it's commodities, but it's beyond commodities. It's futures on currencies and bonds and equities, as you said. Also, I think there's this perception when you think of managed futures, you think about volatility. A very strong risk management process must be put into place, underscored by extreme discipline. Share a little bit about that process for us.
Yeah, no, that's absolutely right. In the old days, managed futures was all about trading in commodities. These days, futures markets have grown tremendously, both in terms of depth and breadth. And if you think about a multi-asset portfolio where we're trading equities alongside fixed income, alongside high volatility commodities, alongside some lower volatility currencies, you're absolutely right that risk management becomes very important, both at the portfolio level as well as how we budget risk across different positions in the portfolio. And so what you'll see us do in our approach is that when we're constructing our portfolio, we're always thinking in terms of risk. How much risk does this position represent? How much risk are we taking on at the portfolio level? And what we look to do is to equalize that risk across different markets. So if you see us holding a very volatile market, something like natural gas, well, you can expect that we're going to have a much smaller position in that market than something that's a much lower volatility market like US 2-year notes. Similarly, at the portfolio level, we're actively monitoring the volatility of all the markets we're trading, as well as the correlations between those markets from one day to the next. So if you see a change in market regime, if you see that volatility spiking, or if we see that our positions are becoming more correlated with each other, then you'll see us proactively reducing our exposures to adapt to those changing risk conditions. For us, risk is an input to our process. We're very explicit about how much risk we want to be taking in the portfolio. It's not just an output that's handed to us by market conditions.
It would be interesting to know is the cryptocurrency universe mature enough where it's given consideration for inclusion in the strategies?
At the moment, we don't trade any cryptocurrencies in our portfolio. And the main reason for that is that our investors are looking for a certain return profile from their managed futures allocation, where they can have some confidence that managed futures will respond the way it has historically. And we're at a point now where we understand how different asset classes, equities, fixed income, commodities, and currencies have reacted through various market cycles. But in that regard, cryptocurrencies are not yet tested, so we don't feel that they're appropriate for this portfolio, but there may be some exciting opportunities to use cryptocurrency futures in different portfolios.
Okay, now I hear all of this and I think to myself as an investor, how is it exactly I am utilizing managed futures in my portfolio? Your answer would be?
If you look at managed futures historically, so if you look at these trend-following strategies, they have a few interesting characteristics that make them very useful in a portfolio context. One is that it's a strategy that has a low average correlation with stocks and bonds. So for investors who are looking for a diversifier relative to their core 60-40 allocation, that's a favorable characteristic of managed futures strategies. Another interesting characteristic is that not only have managed futures on average been uncorrelated with equities and fixed income, but they've had a knack in periods of market crisis or market turmoil of not just weathering that market turmoil, but actually profiting from those dislocations in markets and producing, at times, significant positive returns. We saw that in the financial crisis when managed futures was one of the few strategies to post positive returns in what was otherwise a very challenging market environment. We saw that last year in 2022, which was a challenging environment for both equities and fixed income, but was a positive and very strong year for trend-following managed futures. And there's a very good reason, we think, for that behavior of managed futures. If you think about following trends in markets, well, trends can be very strong when emotions are running high in markets. And in a sense, there's no stronger emotion than fear. And so when markets are in panic, when you see that selling begetting selling that we saw during the financial crisis, or you see that uncertainty about the trajectory of interest rates and the risk of a recession and global geopolitical risk that we saw last year, that drives exceptionally strong trends. And so if you're a systematic trend follower, then you're in a very good position to profit from those behavioral forces that are really driving markets.
So it's really fear and greed which provides the opportunity for the crisis alpha.
That's right. You used a very important term there, which is crisis alpha is a term that's been coined by our chief research strategist, Dr. Catherine Kaminsky, to describe these types of strategies that not only weather crises, but thrive in crises. And so for some allocators, what they're really trying to capture with managed futures is that crisis alpha return profile. And when we construct our portfolio, we're really trying to optimize our portfolio for that crisis alpha return profile. We do that in a few ways. One is by not having any explicit bias, long or short, to equities or fixed income or any other asset classes. Investors have plenty of long bias elsewhere in their portfolio. It serves them very well. If they want something that can be a genuine diversifier, we've worked very hard to remove that bias from our portfolios so that when investors are looking for that crisis alpha, we're hopefully best positioned to deliver it.
Okay, and let's talk a little bit about some prior instances where certainly you and I would know that commodity markets and even futures markets to a certain extent have gone parabolic. You think about the spring of last year, it was agriculture, it was commodities like oil and natural gas that went parabolic.
Right.
And it can go parabolic even as it did in the spring of 2020 when we saw crude oil pricing temporarily go negative. So share the experience, how the strategies were able to navigate those types of environment.
Yeah. Parabolic moves can happen in pretty much any market, and they can happen to the upside or to the downside. And that's why I think it's very important, an important feature of trend following strategies is that they're agnostic about the market direction. And in our case, we're as comfortable following long trends as we are following short trends in any of the markets we trade. Taking last year as an example, in 2022, coming into the beginning of the year, some of the themes that were in force were concerns about inflation, concerns about rising interest rates, and concerns about rising commodity prices. And then with the invasion of Ukraine, those trends only accelerated. And so as a trend follower, we came into the year on the right side of those trades, and then as those trends really went parabolic, we were able to participate more and more. And as the risk level, as the volatility increased in all those markets, you saw us gradually reducing our risk exposure, essentially locking in some of those gains and being prudent about managing the risk of our portfolio. All the while, the yields were rising, causing fixed income prices to plummet. And so we were on the short side of that trade, which was a very profitable trade and a very complementary trade to traditional portfolios during the course of 2022. And that's in stark contrast to, for example, what we saw in 2020, where, as you pointed out, we saw very strong market moves in the first half of 2020, but many of them were in the opposite directions of what we saw in 2022. And during that period, we were actually able to profit from the flight to safety trade in fixed income as markets were absorbing the initial shock of the COVID pandemic, especially in the United States at that time. You mentioned crude went negative during that period. That, we've been trading in crude and other markets for a long time. That was certainly an exceptional market environment, but I think if there's one thing we've learned over the years, it's to always expect a bit of the unexpected going forward, and that's why we think prudent risk management is an important part of the process. In that particular case, because of our emphasis on trading the most liquid markets, we had already rolled on to other crude contracts that were not the contracts that went negative and suffered that liquidity crunch at that period in 2020. So just a reminder that there are different measures of risk that we look at in our portfolio process. It's not just about market volatility, but it's also placing an emphasis on the most liquid and deepest markets so that we can be nimble, so that when markets go parabolic, we can hopefully react to those changing risk conditions and changing trends.
It's great to hear you talk about liquidity, because I think if we reflect back on the prior decade, and certainly since the great financial crisis, the very definition of what it has been for an investor has been about the abundant liquidity. And that's to a certain extent arguably allowed investors a significant benefit in which that liquidity presented passive investing strategies to be optimized. I think you would agree there's been this paradigm shift where with the removal of liquidity, more active management is coming back into favor. It's going to be a strategy as we look forward that's going to be beneficial. Certainly the strategy which you are speaking about today is one that is active in its nature, but it is also one that has been somewhat less traditional than other areas of the market. Finally, just speak, if you would, about the kind of the optimism and excitement you have as we look forward where market conditions are currently, very challenged, very difficult to generate that alpha, but here you are presenting an active management strategy that ultimately does just that.
Yeah, no, that's right. You have to remember that managed futures is an investment style that's been around for years. Large institutions, hedge fund allocators have been using trend following and managed futures in their portfolios for decades in some cases. We were really pioneers in bringing the type of strategy to a wider audience, packaging it in a liquid format through a mutual fund so that more investors and financial advisors and their clients could use it in a portfolio context. And if you look at managed futures over those longer horizons, it's a strategy that's been able to produce a compelling average annual return while maintaining that low average correlation with equities and fixed income, as well as providing that pop, that crisis alpha in very challenging market environments that were the most difficult to hold on to a 60-40 portfolio. If you take that long-term perspective, we think that managed futures make sense in a lot of portfolios. That's what we see from very sophisticated institutional allocators who have strategic allocations to managed futures in their portfolio. And more we see financial advisors taking a page out of that playbook and using it in their client portfolios as well for exactly the same reason, to offset those risks from equities and fixed income that can be challenged in years like 2022.
Yeah.
And looking forward, I think the question investors have to ask themselves is, do you expect the next 15 years to look like this exceptional period of 10 to 15 years that we've just been through, where interest rates have been exceptionally low and the 60-40 portfolio of passive investments has been unbeatable? Or do they recognize that that's a somewhat exceptional period and look to the longer track record where crises are the norm, the Fed isn't always going to be there to prop up equity markets when the going gets tough, and that a diversifying strategy like managed futures can play a significant role in helping weather those bumps along the way.
Alex, I want to thank you so much for your time today, your thoughts. This is incredibly educational for me and certainly for the viewers, and I look forward to more conversations like this in the future.